Okay, so the other category of the ratios is where you use the information from the P&L and also from the balance sheet. So one is the operating free cash flow. Now, what is operating free cash flow? Operating free cash flow means the cash which is available with you from the operations, which is free. So when I say it is free, that means you can use it for anything that you want to use it for. So how do you calculate the OFCF, operating free cash flow? So let's say you have a company and now this company has an EBITDA of let's say 1000. This company has an EBITDA, let's say of 1000. Now what you need to do, you need to deduct from this EBITDA a figure of capex. And why do you need to deduct the figure of capex? Because you have got 1000 from your operations as EBITDA, right? But you have already spent 1100 out of it, which means this 100 is no longer available with you. You got 1000 for sure. You have already spent 100, and that's why this 100 is not available on capex. You also deduct, or you also adjust change in delta working capital. So assuming that your working capital has increased by 200, remember that means already out of this 1000, 200 is lost in the working capital because of this 1000 of EBITDA that you have, 200 is consumed in the working capital. So what is available with you is 700, and this 700 is known as OFCF, operating free cash flow. Operating free cash flow. So obviously jitna ye figure zyada hua utna acha hai, because now this is the figure on which you have a liberty to use it from your operations. The other thing that you have is ROI. How do you calculate ROI? And let me tell you, most people make a mistake. But how should you, when you are calculating ROI, what you should do? You should take EBIT as numerator and investment. Investment, that means total of your assets, current assets and current assets and non-current assets minus current liabilities, investment into 100. So this is how you will calculate your return on investment. Investment will mean total of the investment, I is equal to non-current assets plus current assets minus current liabilities. That is how you will get investment. ROE, how do you calculate ROE? Is very simple. EAT divided by equity, and I'm sure now you would remember equity would mean what? It means equity shareholders fund or shareholders fund into 100. So this is how you will calculate your return on equity. Now this is one number most people are confused. I have seen return on capital employed. So first of all, please understand what does return on capital employed tells you. ये आपको बताता क्या है? ROCE tells you what kind of returns you are giving to the shareholders, or what kind of returns you are giving to the people who have given you capital. So most people will make a mistake. They will calculate. They will take EAT in the numerator, and then they will take the capital employed, and capital employed CE. Capital employed will mean equity plus long-term funds, right? All your long-term funds or long-term debt, because equity is also long-term. So capital employed is nothing but equity plus long-term debt into 100. Now most people take EAT in the numerator. That is wrong. Now what you should take? You should take, not only you should take EAT, but you should also take interest on your long-term debt. Why? Because this ratio, return on capital employed, tells you what? It tells you what kind of returns you are giving to the people who have given you capital. Who has given you capital? Shareholders. Who have given you capital? Lenders. What return have you earned for the shareholders? EAT. What return you have given to the lenders? Interest. So that is how you should calculate the return on capital employed, right? And again, remember, I have already told you How do you do the benchmarking? So if you have calculated return on capital employed for your company, how do you benchmark? Again, compare the current year's return on capital employed, compare the current year's return on capital employed with your last year's ROCE, with your budgeted ROCE, with your competitors' ROCE, or with the ROCE that any business association may have calculated. So this is how you will do the benchmarking. Now, before we take the cash flow, or maybe before we take the cash flow, I think what we can do, we can quickly take a small case about this number, about the current ratio, and then we will take the cash flow statement. So all of you,